Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. It's hard to know what to make of the resources sector at the moment. Iron ore has boomed over the last 18 months, hitting a record high of around $230 a tonne, benefiting both the big miners and the national economy. But it's fallen sharply in recent weeks to below $100 a tonne before climbing back again in recent days. But the miners, from Fortescue to BHP, have all taken a hit. Strange things are happening to gold stocks as well. The price of the precious metal itself has come off a bit recently, but the gold stocks have fallen much further. I wanted to see if we could make some sense of it all. Evan Lucas is the Chief Market Strategist at InvestSMART. Evan, welcome to Fear and Greed.
Hello, Sean. How are you?
I'm well. Now let's start with iron ore. BHP, Rio, Fortescue, they've all benefited enormously from high iron ore prices, as has the national economy and the budget bottom line. Of course, iron ore has fallen off a cliff in recent weeks. How do you see this playing out?
Yes, but it's fallen off a cliff to what is still, I would consider, slightly abnormal prices in this point in the cycle. So I think this is what we need to remember here when we talk about iron ore, is that what has happened during the pandemic is abnormal. The price of iron ore is abnormal. And that needs to be your start point from this. Iron ore will still be a commodity that everybody needs for not only the foreseeable future, but forever, if you know what I mean. Steel is still going to be one of the best construction products on the planet. It will still be required to do many, many, many things. The question that you're asking, though, is how sustainable is it? And, you know, talking about the $230 a ton, and even now sitting here and talking about $100 to $120 a ton, what does that mean? What are we doing here? And I think you need to look at the cycles of iron ore over the last 30 years, and you therefore do need to have a pretty good understanding and looking at what China is and where China sits in that story. Because I think that's all part of this answer, because it's a very, very big question. Why I say that is China is and has been slowing down since 2013 on the construction side. 29% of their GDP is based on real estate and based on construction. And for the last 5 years under Xi, that has been starting to be cracked down on. Regulation is certainly picking up and all those kind of things. So we'll talk about that in a minute. So getting back to your question about what is going on, how do I see it? I actually truly believe that a fair price for iron ore is probably more along the lines of about $60 to $80 a ton on average.
Okay.
And I think that's how you should be thinking in terms of where it is, because that is where the aggregate demand over the next 10, 15, 20 years is likely to sit.
Okay, and that's what the federal budget actually estimates the price of iron ore should be. It was $55 US. I think it's gone up a little bit since then.
It has, yeah.
So, right. So in actual fact, the price is relatively high still if you take the long-term look at it.
Yes. And again, that's not a bad thing. Like what I'm trying to say to you about that is that iron ore is not the only thing that we in Australia should be thinking about.
Yeah.
It will moderate back. It is dominated because it is our largest export by value. I mean, when you are generating 190 million tons for, you know, FMG and well and truly into 300s for BHP and Rio. And then you've got also an Aussie dollar that is near enough to 70 to 75 cents in the dollar. All of those things make that number look incredible. And that's what you talked about with the budget. It makes the economy incredibly powerful. But in terms of what it is, it needs to be thought of as a pool of our overall portfolio in this country. And I think that is what we're now starting to see. I think COVID has been the most incredible acceleration of economic change that you and I have seen in our lifetime. And I think it's an amazing thing. It's actually a really good thing, because it's actually, we keep talking about the Great Reset, which we heard last year. We haven't really heard of this year, but it's been this Great Reset. I look at that from the point of view, not from government, but from the point of view that innovation and development has been accelerated rapidly, and people are now openly expressing the views about where they see the next 50 years, which they probably weren't doing pre-pandemic.
Yeah. Does it all hinge on China? And just keep in mind, I suppose, like India, for example, Modi has incredibly huge infrastructure spends, trillions of US dollars, literally. It seems like a big world out there for Australia, for iron ore particularly. Yeah,
it does. And I'm so glad you highlighted India. This is, I think, also the other thing that this pivot, as I refer to it, has been going on for about 10 years. I mean, if you can remember back in, I think it was about 2013, 14, pretty much at the end of Glenn Stevens' tenure as RBA chairperson, he stood up there and said very clearly, are we ready and are we mature enough to look to India as our future? Because it is. And not only that, the subcontinent and Southeast Asia has always been there, but they have those growth stories to really start targeting in. And India we're talking about 1.1, 1.2 billion people. China's 1.3 to 1.4 billion people. And you would argue that China's probably about 15 to 20 years ahead of India in terms of their growth profile and that economic build-out that you're referring to there, Sean. So India, in terms of that next space, now again, the other argument that comes, though, with India and the China story is that India tends to get its steel from China. So we still send our iron ore to China. It gets refined in China and then it gets sent to India. Is there an ability to actually get smelting and get that kind of material done and dusted in India rather than getting it done through China to have that direct link? That will be part of Modi's story and part of what he's trying to pitch. But we are coming up into a period also where the word clean energy and clean environment also starts to get in the way. So what China could do through the 90s and the early 2000s may be a harder story to do for India in the 2020s, 30s, 40s and 50s.
Okay. Evan, stay with me. We'll be back in a minute. I'm speaking to Evan Lucas, Chief Market Strategist at InvestSMART. Let's move on to gold. Gold confuses me a little bit.
Confuses everybody.
Right. Throughout the uncertainty, the gold price has been steady or actually fallen. It's down around $17.50, $17.60 US an ounce, down from sort of above 1,800. The gold companies haven't done so well. Newcrest, Northern Star, Amelia, some of these sorts of stocks have really fallen. I don't quite understand gold at the moment.
I haven't understood, and I'm going to put my hand up and say this, I don't understand gold for the last sort of 10 years. Yeah, right. And the reason I say that, so, is it a store of value? Is it a hedge against inflation? Is it a trade against US treasuries? All of the stuff you learn at university. What is gold in terms of what it is? Is it also, again, talking about the two countries we've just been speaking about quite strongly, which is China and India, the two largest consumers of physical gold out there, and in terms of what they do, is it driven by that? Is it driven by paper trading and what's going on with regards to the rise of ETFs and using gold of all that kind of thing? So there's so many inputs into gold over the last 10 years that the original idea of what gold was has very much been diluted. Then there are also people that are trying to compare gold with cryptocurrency, and that is a whole nother discussion. Yeah. So let's look at it. Gold is still a very, very useful commodity. It is used a lot in tech, and let's also be aware that tech is the future. The use of gold leafing and gold welding, etc., is the majority of what it's used for. So there is always going to be a need for it. The other thing you've got to probably look at with gold over the last 2 years is that, again, the pandemic has played out into it. It made a record all-time high in, I think it was April last year, where it punched through 2,300 US an ounce. And that was extraordinary. And I remember standing up going, guys, remember what happened in 2011 when gold got to basically just shy of 1,700 or just on 1,700 US an ounce. It fell $800 US in the preceding 7 months. Yeah. So gold also isn't as risk-free, inverted commas, as it once upon a time was. So that is why I find gold hard. Then you've got the added benefit of looking at gold miners, and then you have structural issues inside it. So Newcrest and probably Northern Star, from my point of view, are slightly different. They're obviously well-developed. They are tier one gold mining products. So they are a bit more sustainable. But then when you start looking at the juniors, they have structural stock-specific, company-specific issues, coupled with what is now a very, very volatile, in my words, commodity. I think also then once you start looking at those individual stocks, if you can tie copper to them, then there's also a level of stability rather than just being a pure gold play.
Okay. So let's move on to some of the more energy-based companies. And you think of oil prices at the moment, gas prices at the moment, coal prices at the moment. Yet the stocks aren't rising anywhere near as much as the price of the commodity itself. And presumably that's around the fact that people are just scared about getting into fossil fuels.
Yeah, and I think that's the answer. So we are actually technically in one of the strongest bull markets oil's ever seen right now. And that is astounding. I mean, don't forget, at the end of the April contract last year, there was settlements in that April contract that were actually negative, which means that the oil companies paid people to accept their oil. So we were coming from not just a low base, we're talking about through the floor and underneath it in terms of where we are now, sitting at between $64 US a barrel if you look at WTI, or even as high as 79 to 80 US dollars a barrel for Brent. So that is an incredible acceleration in movement. There is also big arguments being made by some really big investment houses. Goldman Sachs is one of them, Morgan Stanley as well, that we now are actually possibly in a really strong and very, very solid cyclical bull market inside oil.
Yeah.
So that is the here and now story, though. And I think that's the other part to answer your question, is that the here and now story versus, as you highlighted, not just fossil fuel, but the energy mix over the next 10, 15, 20 years is not that story. And I think you need to highlight, and the best one I've ever heard about doing this is, I remember going, and I've been to it 3 times, Shell are always very, very strong on the front foot when they do their presentations from their executive leadership team. And in 2011, they were forecasting that the peak of oil as the main consumption in the world as our primary source of energy would probably finish in 2035. Last year, they brought that forward to 2025.
Yeah, wow.
So when you've got the top 2 largest energy provider on the planet telling you that their product is coming to an end, not to an end, but will no longer be the main use of energy in the planet, that is the signal. And I think, again, let's talk about BHP, because you spoke about that at the start of the podcast, is there is an absolute underscore here when the largest Australian oil and gas producer, which is BHP, not Woodside, as some people believe, is selling out of it. And after having Andrew Mackenzie, who was the head of that division as CEO 7 years ago, to where it was with Mike Henry now, all of that spending, all of that investment for a company that thinks in decades, to do that, I think is also the signal that tells you why energy is no longer going to be this, risk sexy stocks scenario to being a more traditional, long, slow burn as we move away from it.
Evan, we're running out of time. There are a couple I still want to get to. You mentioned copper before. The base metals are doing really well. Nickel, copper, zinc, lead, those sorts of commodities.
Yeah, and they're the futures. And that's what I think we'll finish off on this, which I think is a beautiful thing, is that, make no mistake, what we're seeing is just a mix switch. So you can't deny BHP making a really big song and dance about doing a sign up with their nickel mining to Tesla is something to be seen. The fact that you're starting to hear about Ford and SK Innovation have just announced in the US an $11 billion joint venture to basically develop EVs and EV battery production plants. So that is nickel, that is copper, that is also things like cobalt, it is rare earths. That is what is, from my view, is the exciting thing into the future. And that is what we're seeing the pivot happen. It's not going to happen overnight. It's not going to happen in 5 years. But over the next 20 years, they are going to be the ones that are going to offset the fall in iron ore, in my view. So that also means that you can start taking advantage of the clean energy mix. You're hearing it from the idea of green hydrogen, which I think is a fascinating story, but you're going to have to develop that story, and that's going to require those kinds of minerals and exports to do that. You're also then talking about the future of batteries is a fascinating thing, because there is every chance with what we're hearing at the moment is that Australia could be one of the largest exporters of EV battery energy. We actually make EV batteries. So we're talking about making environmentally friendly energy, store it in batteries and export it. So you've got the double whammy there. You've got the actual product, because nickel, cobalt, etc., we're in the top 3 largest holders of that underground. We'll be able to export it, have it manufactured, brought it back, charge those batteries up through the fact that we have incredible space in our country, and then export that out. So that, I think, is the story that you're going to hear over the next 30 years. And that, I think, is the really exciting thing. And you're already seeing it. You cannot deny that a company like BHP, that you start to hear, and Andrew Forrester and trying to pivot an FMG towards that idea, that it's not going to happen. And then you look to the US, you look to Europe, and the amount of money that has been thrown into this industry, if you agree with it or not, it doesn't matter. Change happens because it just does, and you have to get on board with it. No, people hate change, but it happens. And if you try and fight it, you'll miss it. And that's what I think is now happening, is that there is so much voice around this space that it is going to happen. It's just about being ready for it.
Evan, thank you for talking to Fear and Greed.
Thanks, Sean.
That was Evan Lucas, Chief Market Strategist at InvestSMART. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.